Why did Silicon Valley Bank fail, and were there red flags to indicate the failure was coming? The answer is remarkably yes. In fact, by some measures, Silicon Valley Bank was not solvent as of the fourth quarter of 2022, as evidenced by their financial statements, which we've reviewed multiple times on the channel before. But in this video, what I'd like to show you is a thread by an individual whom I've had my criticisms on before, and that's because some of the things he says I think are pretty dang well put together. Some of the things are a little bit bearishly manipulated. I've made a video talking about how this individual has sort of bearishly manipulated some information and basically called him out on YouTube and Twitter to find out where the actual numbers are as a way of saying, hey, I could be wrong here, help me rebuild your model, and I never heard back. Now, that's not to say that there was any kind of intentional mistake in previous data. It's just to say that what you're about to hear is this person's opinion. It could be wrong, but this set of information actually sounds relatively reasonable. Ready for it? Here we go. MacroAlf on Twitter. Silicon Valley Bank does not deserve a bailout. A deep look at their financial statements reveal how horrific they were at risk management. And in my opinion, incompetence explains only part of it. Moral hazard must have been at play. A thread. What Silicon Valley Bank did with their portfolio is either a signal of enormous incompetence or outright moral hazard at play. Gamble away billions as policymakers rescue you. I can't believe the incompetence reached at these levels. All right. As a result of regulation, banks have flushed their balance sheets with trillions of dollars of bonds. Such a large amount of bonds on the balance sheet also comes with risks, like interest rate risk. And over here, he explains how you can hedge that interest rate risk. Now, I'm not going to explain that in his way because it's very complicated. It's not worth talking about for the point of this. So let me simplify it. Basically, if you're a bank, you want to pay people interest through CDs, certificates of deposits, or yield on accounts. You do that so you could attract customers, right? Makes sense. Somebody deposits $100. If you give them $4, that's a 4% yield. That's pretty cool. Now, what are you going to do with that $100? Well, ideally, you go invest it in such a way that you make more than 4%. Now, that means your $100 isn't immediately available for you to withdraw it. This is why when a lot of people try to go withdraw money at the same time, the bank's like, oh goodness, we don't have enough cash for you because we invested it into bonds or other assets. The problem is, in a rising interest rate environment, those assets lose value. And so now all of a sudden, if people liquidate and get their cash out of the banks, and then the bank says, oh no, we have to sell these investments we made, but rates went up, which means the value of our investments went down, we now have even less money to cover all of the deposits. And that's exactly the kind of stuff that was evident on their financial statements. You could see that very, very easily by, for example, laws that allow these banks to say they have $91 billion of assets, but the reality is this is what they actually show on their financial statement. But on the left side, they actually say, sorry, that's actually only worth $76 million because it's lost money. But the reason we're going to say it's worth $91 billion is because we're holding them to maturity. These assets are not available for sale, so we don't need to write them down. That's basically what they're saying. Okay, got it. Now, there are ways to hedge that interest rate risk by doing swaps. I'm not going to explain what swaps are or how those work because it's really not important to the story. So let's keep going here. What does MacroAlf say? He says, Silicon Valley Bank did not hedge interest rate risk at all. And he shows this chart here that's showing at the bottom, their hedge-adjusted Q4 2022 duration was exactly the same as their portfolio duration. In English, it means they didn't hedge. They used to hedge on the left side. They used to hedge. In Q4, they did not hedge. Okay, so the bank all of a sudden was not hedging despite the fact that interest rates were skyrocketing. Okay, got it. Who takes the risk? MacroAlf says, in my opinion correctly, the depositors take risk. Now, many people are calling for a bailout, but the evidence that moral hazard was at play is too big to be ignored, and we should not reward moral hazard. Here are 3 facts that are hard to ignore. The outrageous amount of accounting tricks, number 1. That's kind of like what I showed you. When you can just take toxic assets and say they're worth a lot less, but we're just going to say we're holding them to maturity. Then all of a sudden you don't actually have to report those losses. All you do is you end up saying, hey, we have a column here of unrealized gains of $2 billion, but we have unrealized, or this is actually $2 million, and we have unrealized losses of $15 billion, which is like an entire year of net income for the bank. Well, now you're playing an accounting trick to deceive people to some degree, right? So number one, accounting tricks. Number two, not hedging. And they talk about how in December of 2021, Silicon Valley Bank had interest rate swaps. But by the end of 2022, they got rid of all of their hedges. So in other words, they used to have hedges, but then they did not. You could see that right here. Look on this right side. It says December 2021, notional or contractual amount of hedge, $10.7 billion. It says right here, to manage interest rate risk on our available for sale securities portfolio, we entered into a pay fixed, receive floating interest rate swap. Basically, we bought a hedge for $10 billion to hedge against the exposure to changes in the fair value of the securities resulting from changes in interest rates, aka JPOW make rates go up. We designate these interest rate swap contracts as the fair value of the hedges, okay? So the fair value of the hedges was $10 billion. At the end of 2022, it was $550 million. So in other words, they got rid of almost all of their hedging by the end of 2022, even though rates were skyrocketing. Okay, makes sense. Not. Number three. So number one, misleading accounting. Number two, they got rid of the hedges they used to have, most of them. And number three, quote, the urge to stay away from tighter regulatory scrutiny. Now, I'm going to simplify this here. He doesn't actually even mention Donald Trump over here. Maybe he really likes Donald Trump. But I don't think what I'm saying has anything to do about whether or not I like Donald Trump or I don't like Donald Trump. This is not a political video. This is just a video to remind you about the courses on Building Your Wealth link down below, because that's the only sponsor of the channel. And it's really high quality content and perspective on building your wealth, whether it's in real estate or stocks or otherwise. And we can do Q&A together and the lifetime access to the course member live streams that you get. Remember, I am a licensed financial advisor, but I'm not your personal financial advisor. I run an actively managed ETF. I sell these courses on building your wealth. I've got a real estate startup, so I do a lot of stuff in the finance world. But without getting into politics, number three, Silicon Valley Bank has been begging for less regulation since at least 2015. And they got less regulation under the Trump administration and Republican Congress in 2018, where they were deemed not a systemically important bank because the limits were changed, which basically meant the bank didn't have to go through the regulation and supervision and stress tests that bigger banks do. In other words, they were able to take on more risk. And now they're defaulting, and now everybody's begging for a bailout. Probably doesn't exactly work that way. Now, you do have a lot of people who are quite fussy right now on Twitter, especially the venture capitalists. The venture capitalists are freaking out. They're trying to cry a foul how terrible it would be that a lot of people are going to consolidate into larger banks to the death of smaller banks. Personally, that's actually what I recommend. Get away from the smaller banks. Get into some of the top 8 banks. Top 8 banks: JP Morgan, Bank of America, Citigroup, Wells Fargo, US Bancorp, PNC Financial Services, Truist Bank, and Goldman Sachs. Those are the top 8 according to Bankrate as of March of this year. Then, it's worth noting that a lot of these venture capitalists are making these sort of analogies like the following. And I think they're really freaking out because they've got a lot of exposure. Here's one. And I actually like Dave Sachs, okay? I think he's a good guy. I think he's got a lot of perspectives. But he says, blaming depositors for a bank failure is like placing the blame for medical malpractice on the patients because they didn't do a good enough job shopping for a doctor. Now, somebody here replied and said, when you sue a doctor for malpractice, does your settlement come for taxpayers? This is actually a really good counter argument here. There are insurance programs in place for that. And there are insurance programs in place for banks, $250K. So it's kind of like if you go into a doctor and you're like, hey man, if you mess up, I'm gonna sue your insurance. Well, that insurance might cover you up to $2 million, right? Well, FDIC, they make it very clear every time you walk into a bank, $250K. There's a sticker on every single teller window, $250K. Now, personally, I actually think it's worth making the argument here that yes, to some degree, there is some blame about shopping for a doctor. Because if you buy a discount doctor isn't like, sometimes you go to certain areas and it's like, here's a billboard. Oh, we'll do, LASIK for $95. And it's like, okay, you're going to do an eye surgery for $95? It's like, oh, let me do a little bit of vetting. Sometimes when things sound a little too good to be true, maybe they're a little bit too good to be true. Maybe some say, maybe some of the benefits that banks were providing, like Silicon Valley Bank, were just a little too good to be true because the bank was taking on too much risk. And maybe that was a red flag. Now, of course, then you have people like Bill Ackman, who has been freaking out for a while, clamoring here. What should the FDIC do? Well, the FDIC should immediately guarantee all bank deposits by Sunday night before Asia Open and call a timeout, run a process to recapitalize the bank and manage the liquidation. Now, I hate to say it, but I have a lot of very big skepticism for Bill Ackman. Bill Ackman was the guy in COVID who went on CNBC demanding that everything be shut down for 60 days or 30 days to slow the spread or stop the spread of COVID while he was shorting the crap out of the market. He made lots of money shorting the market with his freak-out talk. So, I have some skepticism here. Now, there are some other people who also say, let's see here, there's some other people who make this analogy that regulators are basically asleep at the wheel. Here, for example, is the following. It says, only morons in the media could blame a single venture capitalist or all venture capitalists for SVB's demise. I mean, I don't think anybody's doing that. I think SVB is taking most of the blame, or should take most of the blame. But anyway, it happened because SVB mismanaged its balance sheet. Now, I agree with that. I do think SVB mismanaged its balance sheet. I agree with that. However, they also say right here that regulators were asleep at the wheel. My personal opinion is regulators are asleep at the wheel as much as the DMV is at your wheel when you're driving. Now, that might be a little bit extreme, but keep in mind, usually the regulators set up the rules and then they kind of only show up when stuff goes wrong. I hate to say it. That's just the way the game is played right now. I'm not saying that's right or wrong, just saying that's usually what happens. They usually come swooping in when stuff goes wrong. Not every single day. And the reason for that is because they generally focus their attention on what their mandates say, which is focus on the too big to fail banks in the case of banking. So they're not actually like sitting on your shoulder every day when you're driving at your smaller regional bank. This is why personally, I'm not the biggest fan of suggesting, hey, whoa, this is solely a regulator problem. Okay, all right, a little bit of a blame shift there. Who knows? That's just another one of my opinions. So, there we have it. Why did SVB fail? It's probably complete mismanagement of their balance sheet. They're upside down. In my opinion, if they get bailed out, it's probably going to cost taxpayers money. And this is my take. Now, I'm going to make another cup of coffee, and I'm going to do a live stream with my course members in the Elite Hustlers course. All right, folks, we'll see you soon. Goodbye.